Have you ever wondered how mutual funds actually function? Let's break down exactly what an open-ended fund is and why it matters. The term open-ended refers to the fund's ability to create or redeem shares whenever investors want to buy in or cash out. Unlike stocks that change price every second, these funds trade at the net asset value, calculated once per day after the markets close. These funds pool money from many investors to buy a portfolio of stocks or bonds, managed by a professional firm. The main difference is supply. Open-ended funds expand to meet demand, while closed-ended funds have a fixed number of shares available. As more people invest, the fund grows in size. The managers then invest that new capital into the underlying assets of the portfolio. Remember that these funds are designed for long-term holding rather than day trading, given their daily pricing structure. Thanks for watching. Always check a fund's prospectus before investing. Subscribe for more finance basics.